Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Transcat Inc. quarterly report. Transcat Inc. offers a wide range of services and products to various industries. The company's service segment provides calibration, repair, inspection, analytical qualification, preventative maintenance, consulting, and other related services through its proprietary document and asset management system, CalTrack. This segment also offers an online customer portal called Compliance, Control, and Cost, which enables customers to manage their assets and access calibration records securely. The distribution segment of Transcat Inc. sells and rents test, measurement, and control instruments, as well as provides value-added services such as equipment purchase, rental, used equipment sales, and equipment kitting. The company markets its products through various channels, including websites, digital and print advertising, proactive outbound sales, and an inbound call center. Transcat's services and products cater to highly regulated industries like life science, aerospace and defense, industrial manufacturing, energy and utilities, chemical manufacturing, and others that require accuracy in processes and confirmation of equipment capabilities. With a presence in the United States, Canada, and internationally, Transcat has been serving these industries since its incorporation in 1964 from its headquarters in Rochester, New York. The company's services include calibration, repair, inspection, analytical qualification, preventative maintenance, consulting, equipment purchase, rental, used equipment sales, equipment kitting. Its products include test, measurement, and control instruments. Unfortunately, I do not have access to the text that summarizes the reasons for Transcat Inc.'s stock price drop. However, I can provide a general template on how to approach this topic. Transcat Inc.'s stock price has experienced a decline over the past year due to several factors. One possible reason is the company's decreased revenue growth rate, which may have disappointed investors and led to a sell-off in the market. Another potential cause of the stock price drop could be changes in the industry or market trends that are affecting Transcat Inc.'s business model. This could include increased competition from other companies, shifts in consumer demand, or regulatory changes that impact the company's operations. Additionally, internal factors such as management changes, operational inefficiencies, or financial struggles may also have contributed to the decline in stock price. These issues can erode investor confidence and lead to a decrease in share value. It is worth noting that without access to specific data or news sources, it is difficult to pinpoint the exact causes of Transcat Inc.'s stock price drop. However, by considering these potential factors, investors and analysts may be able to better understand the underlying reasons for this trend. Transcat Inc. market capitalization of $1 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Transcat Inc. holds a significant advantage in their industry. Transcat Inc. trades at a higher price-to-earnings ratio of 52 times and a higher price-to-book ratio of 2.06 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth are multifaceted and varied. One key factor is the shipment of products and performance of services, which directly contributes to revenue generation. The acquisition of ESCO Calibration Laboratory, LLC in August 2025 has also been a significant contributor, with $1 million in revenue added since the acquisition. In addition, the service segment has experienced growth across various areas, including calibration services, repair and inspection services, analytical qualifications and preventative maintenance services, and consulting services. Similarly, the distribution segment has seen growth through sales of national brand instruments, proprietary brand instruments, and rentals of instruments to customers globally. Furthermore, revenue from Becknell contributed $1 million in the first 9 months of fiscal year 2026, while acquisitions have also driven revenue growth, with a $9.8 million increase in acquired revenue. The successful integration of historical acquisitions has also been a key factor in driving revenue growth. On the other hand, the primary drivers of revenue decline are largely related to expenses and losses. One major factor is the negative impact of amortization of acquired intangible assets on operating loss, which had a significant impact of $1 million. Additionally, contingent consideration payout dependent on revenue target achievement has also contributed to revenue decline. Operating expenses have also increased by $7.6 million, leading to a decrease in operating income and margin. Furthermore, the net loss for the period due to income taxes has also been a factor in revenue decline. Overall, while there are various drivers of revenue growth, the primary drivers of revenue decline are largely related to expenses and losses. The net income of the company underwent significant fluctuations over the 2 fiscal years. In Q3 FY26, it decreased by $2 million compared to Q3 FY25, and even more drastically in absolute terms at $3.5 million. However, when comparing the full fiscal year, there was an increase of $14.3 million from FY25 to FY26. Nevertheless, this growth was short-lived as net income decreased by $6.6 million compared to FY25. In contrast, profit margins showed a more consistent trend. The gross margin increased in both Q3 FY26 and the full fiscal year FY26. Specifically, it rose from 29.5% to 30.1% in Q3 FY26, and further to 32.1% in FY26 compared to FY25. On the other hand, operating margins declined significantly from 3.1% in Q3 FY25 to a mere 0.1% in Q3 FY26. The distribution segment gross margin, however, demonstrated an increase of plus 3.3%, resulting in a final value of 32.4%. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. One key indicator of this trend is the company's operating cash flow, which has turned positive. Specifically, for the first 9 months of fiscal year 2026, the company reported an operating cash inflow of $28.6 million. This development is a crucial milestone for the company, as it indicates that its business activities are generating sufficient funds to cover its operational expenses and investments. The positive operating cash flow also suggests that the company's management has successfully implemented strategies to improve efficiency and reduce costs, leading to increased profitability. Overall, this trend bodes well for the company's future financial health and stability. The company's debt level has undergone some fluctuations over the past few years. Initially, the debt level increased from an unspecified amount in July 2021 to another unspecified amount in July 2025, following a new credit facility. However, by December 2025, the outstanding debt had decreased to $99.9 million. Interestingly, there is no record of any debt in March 2025. In terms of interest expenses, there has been an increase from $3.6 million in Q3 FY 2024 to $4.1 million in Q3 FY 2025. This rise can be attributed to the company's decision to borrow for the acquisition of ESCO and higher interest rates on its credit agreement. While these changes suggest some movement, it is unclear whether they represent significant shifts in the company's debt level or interest expenses overall. The performance of various segments and regions in a given period can be analyzed from the extracted summaries. The distribution segment stood out as a strong performer, with revenue increasing by $5 million and 19.8% to $30.2 million. While there were no explicitly stated poorly performing segments or regions, some areas within the service segment showed signs of weakness. The margin for this segment decreased by 0.9%, indicating a decline in profitability. Additionally, certain subsegments such as pressure and physical/dimensional may have underperformed, although specific numbers are not provided to confirm this. Management's outlook on the company's future is optimistic. They plan to focus on core disciplines such as electrical, temperature, pressure, physical/dimensional, and radio frequency/microwave calibration. This strategic decision will enable the company to concentrate its resources on areas where it has a strong presence. In terms of financials, management is confident that they can meet their liquidity and capital requirements through various means, including a new $150 million secured revolving credit facility. This move demonstrates the company's ability to secure funding when needed, providing stability in uncertain economic times. Looking ahead to fiscal 2026, management expects high single-digit service organic revenue growth. This projection suggests that the company is well-positioned to execute its acquisition strategy and continue its growth trajectory. Overall, management's outlook is positive, indicating a strong foundation for future success. The company's financial activities have been notable for two key initiatives. Firstly, the company has a history of paying out dividends to its shareholders. This indicates a commitment to returning value to investors through regular distributions. In addition to dividend payments, the company has also engaged in share buybacks. By purchasing back shares from the market, the company is able to reduce the number of outstanding shares and potentially boost earnings per share for existing investors. That concludes the financial summary for Transcat, Inc. Feel free to comment below, and I will be happy to answer them when possible.